Good afternoon, everyone. Today's seminar is about businesses and the three different types of businesses. My name is Nisha Nehru. I'm the founder, director, and lawyer of Nehru Law Professional Corporation. I am going to be conducting this seminar on three different types of businesses, but before we continue, I would like to tell you about myself a bit. So, first off, my name is Nishanthi Nehru. I usually go by Nisha. I am a lawyer who has several years of experience in court services. I have been in the legal field for many, many years, approximately 8 to 10 years of legal experience in various capacities. That includes family law, civil litigation, as well as criminal law and divisional court matters. I've even practiced immigration in the beginning stage of my legal career. So that is a bit about me. I also have extensive experience dealing with clients and customer service, which allows me to actually be understanding and be able to obtain information as necessary to assist my clients in the best way I possibly can. So that is a bit about me. Now let's go to the actual webinar. Today's webinar, welcome, and it's about forming a business. Three main types of business structures. I am Nisha Nehru, and I'll be guiding you through the key structures to help you make an informed decision. This is important because each business structure can change and has various capacities that should be understood before you actually take on the business structure. It also has various liabilities and tax requirements, as well as operating needs. So please make sure that you understand what area of business you're actually conducting, the type of industry you're in, and what type of business you require to proceed in your organization. First off, let's talk about sole proprietors. So, sole proprietors. A sole proprietor is the simplest and most common business structure. It is it's easy to set up, and you have complete control over it. However, you are personally liable for all the business steps. This is also related to all the previous seminars that we've been provided. So if you want to learn more about sole proprietors and the liabilities and the tax requirements, as well as any insurance requirements, you can go back and look at my previous seminars from the past 3 weeks, which actually illustrate in depth and provide in depth knowledge about the sole proprietor and how to be a sole proprietor. Now, let's talk about partnerships. So, partnerships. What is a partnership? A partnership can be formed in several ways, but a partnership is for businesses with two or more owners. There are three types of partnerships, although I'm only mentioning two here. It's because the third type of partnership is very professionalized. It's only required for individuals in specific professions. The first type of partnership is a general partnership, where there is a shared management of all the practice as well as liabilities. Usually partnerships have specific requirements, and they usually have a contract that is formed between the partners and agreed upon on the amount of shares that are going to be divided depending on the amount of investments that are provided within that organization. So remember to look at your partnership agreement in order to determine how your shares are being divided and the amount of investment that you're putting in. However, the liability can still be on the full extent of the partners. Even if you have a 25% share of the partnership and you're considered a general partner, remember that you are still at one or in the legal capacity. If you are sued, you will be liable as a partner to the full extent of whatever is awarded against you. These are important facts to remember whenever you're dealing with partnerships. A limited partnership is a partnership that may invest funds into the partnership. However, they're creating a limited capacity in which they are not taking any liabilities to an extent, only to the extent of what they invested in the business. And their shares are usually the shares that are provided first prior to paying out any other members. So this is important factors to remember in both general partnerships and limited partnerships. The other partnership is a limited liability partnership, which I indicated as a professional partnership. So remember that that would not apply to many professions, mostly accountants or lawyers, and in some instances there might be other professions that may be considered like architectures. But at this point, we won't be discussing that too much. So let's go on to our case study. This is Fire Freeze Limited versus Canada Inc. In this instance, a U.S. partnership incurred potential losses, which the appellant sought to acquire for tax deduction purposes in Canada. Spire Freeze, sorry, Spire Freeze acquired 75% of the partnership and became de jure partner. De jure means just of the law. In the instance of the legal capacity, they became partners. That's all it means. Legal principles that the court determined from this is really important in determining what a partnership is. Before I continue with the legal rulings or legal principle, I will discuss the facts of the case. A U.S. partnership, in this case, incurred potential losses on a project which the appellants, through taking assignment of partnership interests, sought to acquire for use as an income tax deduction in Canada. The corporate appellant, Spire Freeze, acquired 75% of the U.S. partnership interest and was de jure partner of the U.S. partnership. Its affiliate bought the remaining 25% of the shares. Then the U.S. partnership with the Canadian partners sold the project to one of the U.S. partners, which basically they purchased the shares, but then they sold it back to a U.S. partner and claimed for the operational loss. They profitably managed its ancillary low rent apartment project. So this was basically an apartment project in which they had different shares of the partnership and were basically indicated they sold it to another corporation and indicated loss. However, the CRA disallowed the losses. The tax court ruled against them and also the majority in the Federal Court of Appeal. The principle of this case, the main issues to take away from here is this. One of the issues of this case related to the existence of the partnership. The three essential ingredients of a valid partner. What is it? In this case, the justice indicated that as per the case described in Continental Leasing Corp versus Canada, 1998, to SCR, SCR 298, were the alleged partners carrying on a business in common with the view of profit. So those are the three requirements that the court decided were essential for creating a partnership. First, carrying on a business. They were in conjunction, carrying on a business together in common. So it was a common view that they were taking. And then the view for profit. The view for profit is basically they are earning some potential from that partnership. Relying on Bachman and Canada, The court stated that the determination of the existence of a partnership would depend on the true contract and intention of the partner parties as appearing from the whole of the facts of the case. The Supreme Court further held that the courts must be pragmatic in their approach to the three essential ingredients of the partnership and weigh the relevant factors in the context of all the surrounding circumstances. The Supreme Court of Canada concluded that the appellant acquired and actively managed the Termont apartment building, continued operating a pre-existing commercial venture, shared ownership and control in a manner indicative of carrying on a business in common, and did so with a view of profit beyond mere tax advantages. The Supreme Court of Canada concluded that a valid partnership existed. As you can see, these are the requirements that you should be looking at when you're dealing in a partnership. If you're intending to have a partnership with an individual, make sure you are looking at the contracts, you're looking at the fact that whether or not you're actually acting as a partner. Now we'll go on to our next case is Kukor Construction. Next case is, sorry, 1 second, I just must have misplaced. We'll go on to the next case where it says Kukor Construction and Development and Associates, which I'm just going to give you the basics because this is just a case to refer to regarding the partnership. The facts of the case here. In this case, the Court of Appeal emphasized a partnership is not a legal entity, but can not sue or be sued under the firm name for practical litigation purposes. So remember that if you have a partnership, you cannot be sued or be sued on the partnership name. You will have to do the individual lawsuits. So the partnership will have to bring individual lawsuits against any creditors, any individuals, that lenders, vendors, whoever you are suing. You might have to bring the litigation case against the individuals with using your individual name. This is the important fact about this case. Okay, and now we're going to go to what a corporation is. A corporation is incorporated. So if you can see on the slide, it says incorporated. Inc. You can also is for incorporation. LTD is for limited corporation, and corp is just corporation. These are three different types of corporations, which we'll discuss further when I start discussing corporations in the later seminars. However, it is important to understand why these corporations are in existence. Because corporations are separate legal entities. They are important factors in a business structure. We'll go to our third case where we discuss Solomon and Solomon. So Solomon and Solomon is a 1897 case. It's from the House of Lords. The decision is made by the House of Lords regarding a company that Mr. Solomon had actually purchased. So the case facts are as follows. Solomon incorporated a company with members comprising of himself and his family. He transferred his business of boot making, being run as a sole proprietor, to the company. The price of such transfer was paid to Solomon by way of shares and debentures on the assets of the company. When the company's business failed and went into liquidation, Solomon's right of recovery against the debentures ranked over the claims of the unsecured creditors. The liquidator alleged that the company was a sham to avoid unjust exclusions of the creditors. This is important because this is a foundation of where corporations were established. This case provides the essential identity of how a corporation can be identified. So, the principle in this instance, the House of Lords held that the company was duly incorporated and that it was an independent person with its own rights and liabilities. The motives behind the incorporation were irrelevant to the discussion of the rights and liabilities. So that is a very important factor. It doesn't matter what reason you undertake to incorporate your business. It's only the fact that the corporation has its own rights and liabilities. The legal fiction of a corporate veil between the company and its shareholders was created by this case. The company's rights, obligations, and liabilities are separate and discrete from those of its shareholders. This principle was followed in Canada in several cases, such as Lippert and Ford Hotel of Toronto Limited, 1930, 65 OLR 340. So there's several other cases that are relevant that did follow this case. This became a foundational case in understanding what corporations and how they were formed. Now we're going to go to the court ruling, as you can understand, was indicating that the legal entity is separate and apart and has its own liabilities. So now let's go to the next case. As you can see on the screen, NPV Management Ltd. and Anthony 2007. NJ number 103. This is an important case because in this case, the shareholders attempted to sue for damages suffered by the corporation. In this aspect, the shareholders, do they have a right to sue for the harm committed to the corporation? Specifically, there are instances where you may find this to be the case, but it has to be brought as a specific matter under shareholders' agreement. It cannot be brought separately. So the consequences of this separate legal personality of the corporation include benefits and restrictions on the incorporators. On the one hand, by establishing a corporation, the principal derived a significant benefit of the limited liability. So that means because they created the corporation, they had limited liability on that corporation. However, on the other hand, shareholders are restricted in their capacity to sue for a wrong done to the corporation. Only the corporation can sue for the wrong done to the corporation. If the shareholder, however, this may be different if the corporation had done a wrong to the shareholder. At that point, there comes a different existence of the shareholder has the ability to sue the corporation for probably any liabilities incurred or any harm done to the shareholder. However, in this instance, they can't sue. The shareholders cannot sue other parties for the harm done to the corporation. So they may not participate in the corporation with all the benefits of limited liability, but then sue in their personal capacity for harm. It underlies the court's reluctance to interfere with the company's internal management. So as you can see, it's important to understand your responsibilities and the corporation's responsibilities are separate. If you're a shareholder, that does not mean you have the general right to do everything as a shareholder. You may have to provide that right to the corporation for them to be able to sue on the corporation's behalf. So the directors or officers of the corporation will have to take action rather than the shareholders themselves. Now let's go to the next slide. So if we want to compare this structure, as you can see, there are specific features that are important for the organization. First, features a sole proprietor. Liability, there are no protections. Taxes, personal taxes must be filed in order for them to actually claim any taxes. Setup costs, very low. Control, full control. Funding access, they have complete access to the funding. And as partnerships, it's pretty much similar to an extent. However, taxes can be filed under the partnership, and control is only with the general partners. Whereas in an incorporation, you have no liability as a shareholder. You will have, if the corporation is liable, that would be a different, separate liability on the corporation because it is seen as a separate entity. Taxes are flexible depending on the type of corporation you have. And there are a lot of tax benefits and tax advantages for specific corporations with a certain amount of funding. Flexibility is quite flexible. So setup costs are higher, but honest, the business structures are not as expensive as you would think they would be. They are required to pay a few $100s to register and incorporate. If you do have a complicated structure, you might want to speak to a lawyer regarding preparing a shareholders agreement or a director's responsibility and further aspects of the corporation, which is very important to consider, which we'll talk about further along in our other seminars. And so let's go to, and the control is very flexible as well. You can actually elect directors to be able to deal with corporations. So the next topic, how to choose your right structure for you. How to choose the right structure for you. I'm so sorry. I'm a bit ill, so that's why I'm kind of losing my voice a little bit, and I'm trying not to, but I'm doing my best here, so please be patient with me. Thank you. Once you choose your structure, follow these steps. Remember, you need to register your company with the province or the federal government and get a HST, GST, and any kind of tax requirements filings you must do. Open a business account. Make sure that you have a separate account for your business because if you mingle the business account with your personal accounts, they will become an issue when you're doing your accounts for your business. My apologies. Also, obtain all the necessary licenses. These steps ensure compliance and a strong foundation. So, those are important things to consider when you're dealing with your business. As I indicated, make sure to register your business with the provincial and federal government. Make sure to look at the GST, HST requirements. And also, don't forget about insurance because those may be important and essential for your business. Finally, I would like to state that, choosing the proper structure is key to business success. Access your needs, consult professionals if needed, and take the steps towards legally forming your business. So remember that you should be consulting a financial advisor or an accountant or a lawyer regarding your business structure. This will assist you in making sure you put in all the safeguards and as well as making sure that you have completed all the required necessary tasks for your business to succeed, especially in the long run. You won't be guaranteed. If you wait too long, you'll have government officials requesting information, which you will have to pay probably a lot more if it's an urgent matter. So don't wait to the last minute to be able to deal with all of these issues. Make sure that you prepare yourself early as possible and deal with the matter before it becomes too complicated. Thank you for joining today's webinar, and we appreciate your time. And please stay tuned for next week's webinar. We will be bringing more information about various different organizations, including partnerships, which we will tackle next week in next week's seminar. Thank you.